Let me get this thought through. This works a couple ways. You have the optimal scenario, which is you go to purchase a house and you qualify. It goes through underwriting, it comes back, you're good to go. And you just ask for a concession. Then you have the scenario of you go through underwriting and they kick it back because your debt to income ratio isn't good. And that's the scenario that you don't want. However, with seller's concession or concessions, this is how you can use this to get into the home that you particularly want to get into. Welcome to the Roger Sarn Podcast, where we talk all things Army. And I'm your host, Sarn Cruz. And today we are going to be reacting to a video that I found on TikTok. And this is specifically in reference to the VA loan. And this individual talks about how the VA loan can be used for paying off debt, personal debt. And the reason why I want to react to this video is because a long time ago, I purchased this house that I'm in. Well, almost 2 years ago, I purchased this house and I did the same thing he's talking about. So I know firsthand that this works. So he's going to be a realtor. He's getting out the military and he's putting people up on game. So when I purchased this house in particular, I had made a significant purchase maybe a few months earlier. Now, I knew what I was doing because I had heard about this. And as I'm making payments on this significant amount, I asked for the concession. And when I asked her about it, she was like, the worst they can say is no. So she asked, they gave it to me. I pretty much got a free item. And it works. So this is it. Here he is. He's on TikTok. Let me share my screen there, so you guys can see who I'm talking about. And he gives some good game. Let me see where it is. His name is Khalifa the Realtor 27. Khalifa the Realtor 27. And the initial thing that you see on the screen is use the VA loan to pay off personal debt. And let's just let it roll.
So I told y'all this last week, but it looks like I didn't hear it. So I'm just going to say it again. You can use the VA loan to pay off personal debt. I'm going to say that again. You can use the VA loan to pay off personal debt. How it works? Listen real close. When you're buying a house, we can negotiate something called seller concessions. And I'm saying we because I'm getting out and I'm a realtor now. But anyway, we can negotiate something called seller concession. And that's basically money that the seller is basically giving back to you to help you with like your closing costs and some stuff like that, Now, the hack is we can negotiate as much as possible for those seller concessions. Now, the real hack is you can use up to 4.
Now, what I want to do here is he's talking about seller concessions. Now, when you purchase a car, purchase a house, anytime you purchase something or you get into a realm in which you're not familiar with, there's going to be certain lingo, jargon, words that you may not understand. And because of that, I'm going to go into the VA Lender's Handbook and I'm going to walk you through exactly what he's talking about because it's in there, right? So we're going to have a scenario. We're going to talk about the pages because there's 2 pages in which cover what he's talking about. We're going to give you a scenario on what the VA loan itself is in 4 steps on the seller concession and the other percentage that he's going to talk about in a second.
4% of those seller concessions towards whatever you want. Personal debt, car payment, a down payment for whatever else, it don't matter. Up to 4% you can use for anything. Just imagine that for a second. You buying a house and you're still getting money from the seller to actually pay off your credit cards, let's say. Can you imagine? And it's one of the reasons why
I love it. He says, "Can you imagine?" And it's true, right? You gotta think about it. If you're in a bind,
I'm in a bind, Nate.
if you're in a bind and you have a certain amount of debt, because this works a couple ways. Let me get this thought through. This works a couple ways. You have the optimal scenario, which is you go to purchase a house and you qualify. It goes through underwriting, it comes back, you're good to go. And you just ask for a concession. Then you have the scenario of you go through underwriting and they kick it back because your debt to income ratio isn't good. And that's the scenario that you don't want. However, with seller's concession or concessions, this is how you can use this to get into the home that you particularly want to get into. And that's the beauty of this perk. We can call it a hack, strategy, perk, whatever you want to call it. But that's the advantage of it. If you qualify, you can ask for more money and pay off debt. If you don't qualify, you can ask for more money and pay off the debt that's holding you back. And then hopefully that's enough and you qualify. So that's the biggest deal. And just like he said, it's free money. But yeah, they're paying you to get into a house. That's it.
Y'all gotta use your VA loan. It's a beast. It's a cheat code. This is the most powerful loan and the only loan that's gonna allow you to do something like this. Nobody else can do this.
He's right. You can get into FHA loan. You're going to give 3.5%. You can get into a conventional loan. The more than likely thing that you're going to have to do is pay 20% in order to not pay PMI, which is mortgage insurance. And that just it's the bank's way of insuring their loan. So if you don't give 20%, you're going to pay PMI. If you do give 20%, if I'm not, 300,000, 20% is probably like 60,000. And let me know how many of us are just hanging out with 60,000 to put down on a house, on a $300,000 house. This house is $299. I put nothing down on it, right? Yes, you put the 20% down. Your mortgage payment will be lower. That is correct. But there are ways or scenarios in which if the mortgage payment is lower because of the money you put down, you have to live at a certain amount of money or time in order to get that money back. But I digress. Let's go back to what he's talking about.
You're not just buying a home. You're getting paid to buy a home. I hope if I say it like that, it will make sense. I hope so. It does not get better than that. Can it? No. And right now, we are in a buyer's market, which means we can negotiate as much as possible. Right now is your best time as a buyer, especially if you're in the military, to buy a house, because we can negotiate as much as possible of those seller concessions.
Now, he's right. I mean, the percentage, the interest rate is what keeps people from buying, right? Because it's so high. Even if you do an assumable loan, you're going to assume the amount of that mortgage at a cheap rate, but you still have to find another loan or come up with the equity or the rest of the amount. So let's say, for instance, a house costs $200,000. The person paid down up to 180, but the assumable would be 180, but they're selling it for 250. Now you got to come out of your pocket $70,000 or get a second mortgage or loan, whatever it is, right? So it can be a buyer's market depending on how you do it, even with high interest rates.
And if you didn't know, now you know. Now you know.
I love it. And if you didn't know, now you know. All right, so let's go into the VA Lender's Handbook. Let's get in there real fast. Yep, we're in there. And this is talking about borrower fees and charges and charges for the veteran borrower, right? So the policy is the seller, lender, or any other party may pay fees and charges, including discount points, which we'll talk about what points are, on behalf of the borrower. VA regulation limits charges made against or paid by the borrower. They do not limit the fees of the payment of fees and charges by other parties, right? And a lot of times they'll tell you, and I'm not going to get into this, but a lot of times people put down on a VA loan and you really don't have to, okay? The only exceptions are excessive seller concessions are prohibited. Like if you're trying to OD on the concessions, it's just not going to work out, right? And we're gonna go into the next chapter. Okay, chapter 5. Let's go. Here we go. Seller's concessions. So, what's the definition of the seller for the seller's concessions? For the purpose of this topic, a seller concession is anything of value added to the transaction by the builder or seller for which the buyer pays nothing additional and which the seller is not customarily expected or required to pay or provide. An example of that can be the closing costs, right? You're expected to pay a closing cost. It is what it is. So whatever that percentage is, you pay it and then you move forward. Okay. Now, seller's concessions right here. Bravo. I don't know why it keeps doing this. You see that every time I click? All right. Seller's concessions include, but are not limited to, this is military or Department of Defense related when we're talking, when it says included, but not limited to the following. That right there, that annoys me. Payment of the buyer's VA funding fee. So you can pay the VA funding fee. And like, for instance, I think this was almost $9,000. If I knew what I knew now, I didn't know this at the time. I just knew concessions. And this is why going into the VA lender's handbook, you can just type this in online, VA lender's handbook, and you'll get it and you can read through it and get to know what they're talking about. Okay. But if I knew what I knew now, I would have got that in there too. We're talking about prepayment of buyer's property taxes and insurance. So you can have concessions to the point that you'd be like, hey, what I want to do is I want to pay the property taxes for next year, and I want to pay the property tax and the insurance for the year as well. Whatever insurance you get, and that'll be part of the concessions. They'll cut you a check. Once it's time, boom, you get that. Gifts such as television sets or microwave ovens. Now, both of my homes are new builds. I'm not flexing, but it is the situation in which I found myself. So for some reason, since COVID, apparently builders have lost the art or the connection to getting a refrigerator put in. I don't know how they did it, but they did it. They can give you a microwave, they can give you a dishwasher, and they can give you a stove. But for some reason, they just lost the connection. So that could have been an example of that. Had that refrigerator in there. Then we have the next thing is payment of extra points provided permanent interest rate buy downs. And that's a lot of times what people do. A good rule of thumb is to make sure that it's a permanent buy down. Some buy downs are only a year long. So you say you're at a 7.5%, because we're going to talk about the example in a second. You're at a 7.5%. You buy down only a percent. Let's say, for instance, so it's 6.5%, but it'll only be a year. So now let's say you're paying $2,000 for mortgage for that year, and you didn't calculate because you didn't read it or you forgot about it. And now now we're talking about it bumps up to 2,600, and you didn't plan for that. And you're like, oh my God. And this is how a lot of people default. So make sure that when you buy down, if you're going to buy down, it's a permanent buy down and not a temporary buy down. Life hack. Then the next one is provisions of escrow funds to provide temporary interest rate buy downs, and then we'll talk about the last thing. So provisions of the escrow funds is what kind of like, let's think of it as a kitty. If you've never purchased a house, every month, you're going to pay the balance and interest, the payment and interest. Then you're going to have an escrow included in there, let's say $200, and that's the forecasting of how much your property taxes are going to be on that house. And with new builds, for instance, and I only talk about new builds because that's all I know, because I've only purchased those. It's hard to forecast a property tax on a property that has never existed. So it's a lot easier if you buy an in-place home, because they already know that you can look at previous years and get an estimate of how much it can be. So that's the difference. That's one of the benefits of buying in-place homes. And then the last thing, which is what he is talking about, paying off credit card balances or judgments on behalf of the buyer. So that just means everything he was talking about is asking for a concession. You got $10,000 worth of accrued debt. They cut the check to each individual lender that you owe. Now, let's keep going. Seller concessions do not include payment of the buyer's closing costs, which I mentioned before, or payments of points as appropriate to the market. And we'll get into that. Example, if the market dictates an interest rate of 7.5% with 2 discount points, the seller's payment of the 2 points would not be a seller concession. Now, if the seller paid 5 points, 3 of these points are going to be considered a seller's concession. Now it says right here, if the market dictates an interest rate of 7.5 with 2 points, with 2 discount points. So that means that you can purchase up to 2 discounted points in order to get it down to a different amount, right? So, and then it talks about what the problem is, that builders offer concessions as a competitive tool. And sometimes the concessions may entice unwary and unqualified veterans, which is what I'm talking about. What is that temporary buy down, and then you're going back up, right? And then it says right there, because at the end of the day, you're going to be buying a home that you can't afford. And if that temporary buy down goes up to $2,600 and you only budgeted, or your allowance is only $2,000 because you just don't make no more money, then you would default. And they can qualify you with the buy down. All they want to do is sell the house. If you default on the house, they'll take it and they'll sell it. They're going to get their money regardless. Okay, so let's look at an example. We'll talk about this 4% in a sec. These 4% limits in a second. But what I want to do is I want to share my screen. Here you go. So we're going to be looking at the cost of 5 points in this example. Okay, so you're going to go purchase a house. We're going to talk about the cost of 5 points, how much interest rate might drop if you purchase those 5 points, because we're going with the example that's in the book. Monthly payment differences, just the principal and interest, P&I. And then we're going to talk about a break-even point if you decide to buy those points. Because if you're going to spend this money, you got to be able to at least break even so you can say you got your money's out of it versus in the negative, but we'll talk about it. So we're going to say 1 point equals 1% of the loan amount. So if we have a loan that's $300,000, what you're going to see is that 1% of the 5% of the 300,000 is going to be 15,000, because 1% is $3,000. So 3 times 5 is 15. Okay. So if you put in a calculator and you say $300,000 multiplied by 1%, it'll give you 3,000. Step 2, how much interest rate might drop? This is just a rough estimate. I'm not a loan officer. I'm just going off of quick maths. I'll put it on a PowerPoint, and plus or minus $100 or $200. Okay. Or 0.25% or so. So the rough rule is 1 point is going to take 0.25 off your interest rate. And it, like I put in there, varies by lender. You're not going to hold me accountable to this, okay? It depends. Now, 5 points times 0.25 is a total of 1.25 off the rate, right? A reduction. So if you take 7.5% and you take away 1.25, you're going to be at 6.25%. So if you gave them $15,000, you bought down to 5%, you would be from 7.5% down to 6.25. Now, at the end of the day, you go into the third step, and you can negotiate this, right? If you go into the third step, which is the monthly payment, it's going to be at 7.5%, you would be paying $2,098 a month. If you are at 6.25%, it would be $1,847 per month. And that's a difference of $251. Is it worth it? Let's see. You paid $15,000 up front, which is going to take you 60 months or 5 years to break even, to say I got my $15,000 worth. So if you stay in the house for 5 years or longer, you're going to be at a net positive, net savings. If you sell or refinance before that, you will lose money. That's it. So for instance, if you PCS, and this is the deal that you get a $300,000 house, you want to buy 5 points down, you want to give them $15,000, you cannot PCS if you got here now in 2025 until 2030. If you want to break even, you cannot refinance and you cannot sell. If you do so, that $15,000 up front, you're going to lose. And depending on when you sell, that's how much you're going to lose. Okay? That's number one. Now, let's go back into the VA lender's book. Let's go back in there. Where are we at? And we're going to read the 4% limit. Any seller concession or combination of concessions which exceed 4% of the established reasonable value of the property is considered excessive and unacceptable for VA guaranteed loans. Do not include normal discount points and payments of the buyer's closing costs and total concessions for determining whether concessions exceed the 4% limit. So the closing cost, if it's $8,000, that does not go into the factor, okay? And the normal discount points, which are the 2%, don't worry about it. Now let's go back and look at an example of that. Let's look at an example of the 4%. So we're going to do this in 4 steps as well. Step 1, we're going to figure out the 4% limit. So the VA seller says concessions cannot be more than 4% of the home's value. What's 4% of the home's value? $300,000 times 4%, and that's going to give you $12,000. That's the maximum concessions allowed that you can do on that house because it's 4% of that. Now, step 2 is what counts towards the limit, the $12,000 limits. We have to figure that out, right? It's the extra perks that are beyond that normal cost. So if paying more points than typically given, like 7 points, 8 points, that's too much because it's going to put you over. Giving furniture, that's still part of it. You got to take how much the amount is. And paying off debts, you have a certain amount up until what debt. So we'll talk about what the cap is for this. Well, $12,000 is the maximum. So normal discount points, it's what's standard in the market, and the closing and normal closing costs do not count towards the 4%. So what was the example? It was 7.5% with a market dictated of 2 points. So those 2 points don't count, but we're going to keep going. Number 3, we're going to be applying the same scenario. Normal market rate of 2 points equals $6,000. Remember, 1% of $300,000 is $3,000. I almost forgot. Seller pays 5 total points. The extra 3 points are called concessions. 2 points dictated by the market, 3 points extra, as we talked about in the previous example. So extra 3 points is a total amount of $9,000. Step 4, checking the rule, because that's the criteria. 12,000. We found what the criteria was, which was the $12,000, and now we're talking about the concessions. The concessions counted are $9,000. Those are the extra points. Limit $12,000. $9,000 is under the limit, so it's acceptable for the VA loan. And that's it. These are things that we got to take into account when we're working with the VA loan, because many of us, we just don't know. Like, we literally just don't know. We live and we learn. We listen and we don't judge. I was wondering, why can't I see anything? I don't have my glasses on. My glasses are right here this whole time. I'm like, why can't I see anything? It's because I don't even have my glasses on. What a weirdo. All right, cool. So yeah, watch this video a couple times. Go on his page. He's giving some good information. You just have to understand that the VA loan is not just like a regular loan. Like I told you earlier, it's a hack, it's a benefit, whatever you want to call it. But it can be used for more than one benefit. Well, for more than one benefit, right? Because you're going to buy the house and you're going to qualify for the house. You're going to not have to give a down payment. And then you could potentially get paid for that by what? Seller's concessions. So do me a favor, share this with your team leaders, your squad leaders, anybody that you know that's eligible for a VA loan. Also, drop a comment if you found this information helpful. This is that's my whole goal. That's my calling, to help every junior troop out there, even seniors, but my goal is you guys, the junior troops. Like, subscribe, and follow for more Army content. And remember, you don't have to embrace the suck if you got the right tools in your ruck. I'm Sergeant Cruz, and I'll see you in the next one. Peace.
Roger, Sergeant.